North America's largest natural gas utility, just posted their latest earnings report, and the least we can say is that the results were pretty good. So today we'll dive deep down into these latest earnings report to see what has been the financial performance of Enbridge lately, and then we'll project what is the true intrinsic value of this company according to different valuation models to determine whether or not this company is currently over or undervalued right now. But before, let's check out their business model. So how are they able to generate their income year after year? Enbridge is currently ranking amongst the 20 largest energy companies in the entire world by valuation, with a market cap exceeding $100 billion. As any great energy company, the main income source of Enbridge comes from the transportation of their liquid pipeline. Enbridge currently operates the world's longest and most complex crude oil and liquids transportation system, covering about 30,000 kilometers all over the continent, where it also transports over 30% of the total crude oil that is produced in North America. This liquid pipeline branch currently represents by far the most important of their total income sources, where it accounts for over 46% of their latest quarterly earnings. Their second largest income source comes from their gas transmission and midstream branch. On its side, this branch is mainly responsible for the transportation of natural gas and propane all over the continent. With its gas transmission and midstream pipelines that cover about 120,000 kilometers, this helps them to move about 20% of all the gas consumed in the US. This is a pretty important statistic to understand about Enbridge, especially with the numerous threats that have been made by President Trump about potentially imposing some tariffs on Canada. This basically means that a company like Enbridge really has an important impact for the US economy in terms of all the energy that is consumed in that country. At the moment, this part of their business segment is currently worth about 25% of their total EBITDA that have been reported in their latest earnings report. In third place, we now have the gas distribution and storage branch, which is reflecting all the energy that they are storing before to sell it. At the end of last year, on that regard, Enbridge has completed its acquisition of 3 natural gas distribution companies from Dominion Energy for about $14 billion. This is one of the main reasons why Enbridge has become North America's largest natural gas utility, where it is able to serve over 7 million customers per day. Nevertheless, even if this branch has been able to grow close to 100% year over year in their latest earnings report, it still accounts for only about 20% of their total EBITDA that have been reported. Finally, the fourth and last branch of Enbridge that has been able to gain over 2 times more value compared to what it was worth back in 2023 is their renewable power branch. Since 2002, with a cumulative capital investment of over $8 billion, Enbridge has been able to work on developing numerous renewable energy projects. This is some excellent news for all the investors that are looking to invest in energy companies that are not only exploiting the natural gas and the oil sources, but also different renewable energy sources, because it is important for these companies obviously to make profit right now with the oil business, but also to adapt to tomorrow's environment. On that regard, at the moment, Enbridge is currently operating about 23 wind farms, 13 solar energy operations, and 1 geothermal project, mainly located in North America and Europe, which are generating enough power to meet the electricity needs of over 1.3 million homes. Despite that, in their latest earnings report, we've seen that this branch was only worth about 10% of the total earnings of Enbridge. So globally, we can see that this Canadian company currently has an excellent diversified business model that has been fueling growth by multiple acquisitions that have been made in the past. Plus, even if it currently has quite a high amount of debt with a debt to equity ratio exceeding 100%, this business has still been able to achieve some excellent growth over the past year. However, over the past couple of days and weeks, we've assisted to a certain decline in the valuation of Enbridge, linked to the multiple threats made by Donald Trump about the possibility to impose tariffs on Canada and on the energy. But as I mentioned earlier, with the importance and the significant amount of products that is exported by Enbridge to our southern neighbor, the CEOs of Suncor and Enbridge are not anticipating any financial impact of these tariffs on their next earnings reports. But talking about the earnings report, let's take a look right now at their latest earnings report to see whether or not this 6% quarterly dividend company could be a great addition to your portfolio. First, we can notice that they've been able to outperform the analyst expectations for both the earnings per share and their total quarterly revenue, where in terms of the EPS, they were expected to report 74 cents per share and they've reported 75 cents per share, meaning a slight increase of 1.41%. And in terms of their quarterly revenue, they were expected at $7.70 billion, but they have massively increased to over $16 billion, or a gigantic increase of over 110%. However, out of their 3 past earnings reports, we can notice that they've missed the analyst predictions in terms of the EPS 2 out of 3 times. Now, when we take a look at their latest financial results that were reported on the February 14 of 2025, the first thing we can notice is that since it has been the last earnings report of the year, we can see a 2024 recap. This recap is particularly interesting for the investors because it is showing the important highlights of the company over the past year. For example, we can notice that they've been able to grow by 13% their total EBITDA compared to what it was in 2023. We've also seen that for 30 consecutive years, they've been able to grow their dividends, which makes it one of the best dividend aristocrats in Canada. They've also been able to achieve an excellent 37% total shareholders return in 2024, meaning that when you add the total capital gain with the total dividend that they've been distributing, this is giving us about 37%. And we can also see, as I mentioned earlier, their $19 billion acquisition has been completed for the 3 premier US natural gas utilities from Dominion Energy. For the next page, we also find an interesting statistics in terms of their predictable cash flow that have been able to increase for 19th consecutive year in 2024. This is some great news for the investors, showing that Enbridge is able to continuously grow year after year. After, we can find other interesting highlights about their other business segments, which can be pretty interesting to understand how the company works. But what interests us is their quarterly financial results, where we can notice, as I mentioned earlier, that their adjusted EBITDA have been massively increasing year over year. And overall, we can see that even if their maintenance capital, their financing cost, and their current income tax have all been increasing year over year, their total distributed cash flow that will be used notably to distribute all the dividends to their shareholders have still been able to steadily increase compared to the same period in 2023, which has been the same in terms of their adjusted earnings per share. This reaffirmed their financial objective for 2025 in terms of their adjusted EBITDA, where they are expecting a 9% growth in terms of their compound annual growth rate. And for their discounted cash flow per share, it is a 4% growth rate that is expected. And finally, for those that are interested by it, we can find that at the end of their earnings, we find all their different business segments one by one to see all the capital that is invested in them up to date. So it can be a great way to see how their resources are allocated to each segment of their business. And finally, as always, to determine what is the true intrinsic value of Enbridge right now, we'll be using first the Peter Lynch valuation model, which is a simple formula where you add the future growth of the earnings per share with the dividend yield and that you divide with the PE ratio. And according to this model, we could find that this business would currently be slightly overvalued. However, for the second model, which is the dividend discounted model, we can find that with all the inputs, this company would currently be quite undervalued compared to what would be its intrinsic value. The third model that we'll be using now is the discounted cash flow model, where we'll simply find what are the future free cash flow of this company and where we will discount them to find what would be our future enterprise value. So we first need to find what is the cost of debt, the cost of equity, and the cost of debt and equity to find our weighted average cost of capital. And then with this WACC, we can find that the intrinsic value would suggest that at the moment, this company would currently be quite undervalued as well. Finally, for the two last models, we'll be using the Graham's original value formula and the Graham's revised value formula. And in that case, we can find that for the original value formula, this company would currently be undervalued. But in the case of the revised value formula, this company would currently be overvalued. As you've been able to see, the different financial metrics and the financial models are not showing us the same interpretation of these numbers. However, in my personal opinion, Enbridge is a must to have on your watch list, especially if you're looking for dividend growth with an history of increasing their dividends for the past 30 years in a row. And if you're looking for a company that is operating in an essential market and that has a well-diversified business model. Add to this with a pretty fair price earnings ratio and with some great financial results that they've been reporting lately, this could potentially represent a great entry door if you would be looking to invest in the long term. It is why personally I've decided to add a few more shares of Enbridge to my own portfolio before the ex-dividend date last week to be able to earn also the next dividends that are coming in March. But on your side, if you're looking for another Canadian company that has just been reporting their latest earnings report, well, check out the video. That's gonna be right over here, and I will see you soon. Peace.